corporations shop the states and shop the localities to get the most benefits, and then go to the one that gives them the most benefits. And so the one that gives them the most benefits is the one willing to have the lowest levels of education and the least public services for everybody else to be able to get those jobs in. And the ones that aren't willing to do that don't get them, and they're even worse off. Same thing with the environmental regulations. We left all the states to do that. And so the states that allowed the most environmental degradation got the most businesses. Then the rivers in Ohio start catching fire, and they realize you have to have federal standards to stop these companies from playing these regions off against each other. So it's like the classic example is if you go to a football game and you stand up, you can see better. But then the people around you can't see better, so they all stand up too. Well, now nobody can see better and nobody can sit down. So you have to have collective action. And it's a role of government.
This is the MMT podcast with Patricia and Christian Riley. Hi, I'm Christian Riley and welcome to the Modern Monetary Theory podcast. You can find us on Twitter at MMT Podcast, and you can support the show by going to patreon.com/MMT Podcast. For as little as $1 a month, you can get early access to all our episodes and patron-only episodes. A big thank you to all our supporters so far. At the beginning there, you heard our guest this week, MMT founder Warren Mosler. And in a moment, we're going to hear part 2 of our interview with him based on questions written by our patrons. A link to part 1 of the interview is in the show notes, so please have a listen to that if you haven't already. And also, if you're totally new to MMT, there's a link to our first 3 episodes where me and Patricia lay out the basics in an easy to understand way. Before we dive in, some notes about some things that came up in the conversation. Regular listeners will know that a good jumping off point to bear in mind is that your government or its designated agents is the sole issuer of the currency you use. While there are exceptions to this, it's certainly true for many countries in the world, such as the UK, the US, Japan, Canada, New Zealand, or Australia, to name a few. As I see it, the rest of MMT is largely about getting to grips with what that means for you and me. Many people are drawn to MMT's implications for the basis of austerity, namely the idea that your government's just about to run out of money. Spoiler alert, that's poppycock, or for our American cousins, bullshit. Monetarily sovereign governments create new money every time they spend, so as the issuers of currency, by definition, governments like these can't run out of money, and the politician that says otherwise is either lying or, as Warren likes to more diplomatically put it, committing an innocent fraud. So in this interview, Warren talks about the interest income channel, and to understand that, you need to bear in mind that the government is a net payer of interest to the economy. So that means that when interest rates go up, interest payments from the government to the private sector also go up, giving the private sector an increase in potential spending power. So contrary to orthodox thinking, Warren and other MMT economists think that raising interest rates likely imparts an inflationary bias to the economy rather than cooling it down. And there's more about that in our episodes 59 and 65. Warren also mentions the automatic stabilizers, and that means the automatic spending and taxing that happens in response to the business cycle. When the economy's booming, private sector earnings go up, and as a consequence, tax payments from the private sector to the government also go up. And at the same time, unemployment comes down, so support payments from the government to the private sector also go down. In a recession, the opposite happens. There's an increase in unemployment, so payments from the government to the private sector go up. At the same time, private sector incomes go down, so tax payments from the private sector to the government also go down. The overall effect of these dynamics is that the government deficit expands and contracts to counter the business cycle and supposedly automatically stabilize the economy. But anybody that's lived through a recession will tell you it feels about as stable as Donald Trump's internal monologue. You can listen to our episode 9 for more on automatic stabilizers and our episode 47 for the MMT proposal to improve them. I've linked to all of the above in the show notes, along with more of our interviews and essential writing by Warren, plus a few other things that came up in the conversation. And as ever, I've linked to where you can support this podcast financially via patreon.com/MMT podcast. Support starts at $1 a month, which is 75 British pence at the time of recording. And no matter what level of support you give, you get early access to all our episodes and patron-only episodes where you can ask me and Patricia MMT questions. We are 100% supported by you, our wonderful listeners. Your financial support really helps keep the show going, and your support in other ways, whether it's by recommending us to other people or just by listening and spreading the word about MMT, really helps too. So thanks as ever for the time you put into understanding MMT. Let's dive in. Well, let's move on to another question. This is from John Camden. Does Richard Murphy of Tax Research blog get MMT? He seems to be very influential, and I know that many people think he is an expert on MMT. After reading many of his posts and tweets, I have my doubts on QE, government debt, gilts, bonds, and taxes. He seems to muddy the waters. Kind of hybrid position, which does nothing for the clarity of the MMT message. I'll just jump in and say I'm fond of Richard's, and I think he, but I do think he differs from MMT in it's fair to say, and I don't think he would take issue with it that he does differ from MMT in some respects. What's your take?
Well, I've never spoken with him, and I've offered a couple of times to speak with him again recently, and he said he would, and then I've never heard from him, and then. He said, look, he's trying to take positions where that on a practical level can get into policy. And that's his major concern, and not so much the technical details behind, the operational details behind the monetary system. So I don't know, look, some of the things I read, it's the things I read that he'd written that caused me to say, hey, look, you want to talk about these things so I can give you the fundamental position and how this works and where there's support for your policies and where there isn't. And he said yes, but then he never gets around to it. So, I'd have to say it's not that important to him that people think he's MMT or he isn't MMT.
Plenty of people are very MMT friendly. Who know they're not MMT. Steve Keen is very, very close to MMT, but there's a few things, and you guys have spoken directly about it. And and to be fair, Richard did. I think you did a guest post on Richard's blog, which is, I think, the important people in this whole equation are Richard's audience. They're curious. People who are having a worldview informed by, the stuff that Richard's bringing to them. It's not all Richard's.
We were supporting the same ends. And so I had support for the same ends that he had, the same policies, and he liked that, and he liked my train of thought, so he put it up there. But that to him was just one, source of support for what he's got going, and then moved on to other sources of support, which might not have been considered, by myself as, I don't know, logically consistent or something like that. But he's certainly, if he wants to get deeper into it, I'd be happy to talk with him. If he doesn't, that's fine. It's
okay. Well, I'm
not looking for work right now.
But I think a bit more synergy would be great. I guess we'll see what we can do. Because I've had a back and forth with Richard online, and I mean I've spoken to him. We've had him on the podcast. He's I think he's great at talking about some aspects of MMT. I think where he differs, and this happened on Twitter, so it's not the best place for these things, but he wrote a piece about this is definitively MMT as I see it, and he said government spends first and taxes are paid after that, and I think I just did it in a tweet, and I said, but actually the very first thing is the tax liability. Government creates the unemployment through the tax liability, creates this vacuum for the government to spend into. And He didn't like that.
Yeah. But he's correct that spending, if you just want to look at the flow of funds, spending goes from government to the economy first and then back to the government. So his flow of funds was correct, but he wasn't that interested in the stuff like you were talking about. He didn't, it wasn't important for what he was trying to get at.
Yeah.
And he probably thought it was a complication. He's not saying that, he probably didn't say you were wrong. He just doesn't want to hear about it.
Fair enough.
It's like, to him, that's like nitpicking or something.
Yeah.
It's like a distraction.
The reason I like that starting point is because people don't like I love your guy with a gun model, right? People don't like the coercive. Some people don't like the coercive nature spelled out quite so blatantly. Yeah. So I like to start with the government created unemployment and go, well, why did they do it? Did they do it just to be mean? Of course they didn't. They were put into power through something that we like called democracy, hopefully, to do a bunch of things that we want doing collectively. And so we gave them permission to do this. So that's why I like to back all the way up to, the government desiring to prevent this.
Look, he's looking at the immediate problem, which is deficit spending and the budget. Based on that, it makes sense to start with the idea that spending comes first, supplies of money, some gets paid for tax, and the rest is used to buy bonds. So there's no problem with this deficit spending. Yeah. So if he's trying to convince MPs, that's not a bad place to start. And you don't have to know the rest of it.
I take the point, but these are all, every now and again, he will write a piece that is, this is definitively MMT. Not just but you know what I mean? And that's kind of like when, I think I'm polite about these things when I just sort of say, I always couch it in terms of like, look, I think this is where I've seen this before, and I refer them to something that you or Bill or Randy has written. I don't go, look, I know MMT. I'm telling you. I go, well, look, these are the MMT architects, and that's what they say. So, but that's. But yeah, I think a lot. We'll see what we could do, and I think you guys would have a great chat.
Yeah, I do too. Yeah, because he's got the practical side where he's got these contacts and where he can affect change. So it's an important avenue, I think, for affecting change.
Great stuff.
Where he is good, though, is when it comes to taxation, and I think that's where he might have quite a lot to contribute. But here's a question that is actually relevant to that. It is by Darren Quinn, and he says, it may have misunderstood a recent interview Warren did with Steve Grumbine. Did he basically say that the overnight rate is the inflation rate? And I guess I'd like to attach my own question to that, is that you often say that the controlling the interest rate is a very bad way of attempting to control the inflation.
That's right.
And what's the relationship between that, you think?
Right. So part of that conversation includes the definition of the rate of inflation. So if you ask the Federal Reserve or the Bank of England, what's the rate of inflation, they'll tell you what it was last month, 0.2 or something. That the CPI went up. Well, what's that? That's some index that they had. Or they'll tell you that, our forecast for next year is 2.1 or whatever. So it's a forecast. So that's not the rate of inflation either. So number one, they've got some kind of an index. Number two, they can only measure where it's been or forecast it. They don't know. So I said, okay, well, what is inflation academically defined? The academic definition of it is a continuous increase in prices. And so I thought about what that actually means. And to me, what that means is a continuous increase in the term structure of prices faced by somebody alive today, somebody participating in the markets today, somebody buying or selling today. So, for example, if I was a jeweler and I wanted to buy gold and it was 1,000 pounds for an ounce of gold for delivery today, but I'm a jeweler and I might want to buy it for delivery next year, a year from now. And I call the supplier and I say, how much is it going to cost me? But I don't want to pay for it until next year when it gets here. And if the interest rates were zero and there was no storage costs or insurance or that type of thing, then it would still be £1,000. If there was an insurance charge or something else, it might be a little bit more for whatever, risk of theft or something. But some kind of, if it had to be air conditioned, which gold doesn't, so there wouldn't be much of a charge to say. He'll say, "Yeah, I'll deliver it a year from now. Cost you an extra £20 or something for insurance." All right, but it'd be the same. But let's say interest rates, the policy rate for that year was 10%. Now, if I want to buy it for today and pay for it today, I pay £1,000. But if I want to buy it for delivery next year, I pay £1,100 because that's the interest rate for the year. Because he's not going to get paid till next year. I get to keep my money earning 10% for a year. He doesn't have his money. He might have to borrow it or something at 10%. So the indifference levels are the forward prices, which are discounted by the interest rate. It would be 10% higher. And so if you look at the futures market, when interest rates are zero, the price of gold is pretty flat, whether you buy it today or a year from now. And when rates were 10%, it was 10% or so higher for a year from now. And that's just arithmetic. And it's the same for all commodities that are not perishable. It's different for fresh fish. That's different. But that takes on a relative value to commodities that are non-perishables. So you could say, if you think relative value stays about the same, then if rates are 10%, all prices for buying things for delivery a year from now are going to be about 10% higher. If you want to build a house, the builder has to borrow the money to build it. You're not going to pay for it for a year. He's got inventory costs, interest costs, and whatnot. You've got your money in the bank waiting. The fact that it's 10% higher a year from now is not a big deal, because if you want to order it for a year from now, because you're going to be earning interest on the money you haven't paid for. Or if you're going to take a mortgage out, you don't have a mortgage payment until next year. You just saved 10%. Okay, so what I'm saying is the price level faced by today's people, business people, agents, individuals, for the term structure of prices they face now for buying things for today or for forward delivery, for future delivery, is a direct function of the interest rate, the policy interest rate. So in Japan, in Europe, where you have zero rate policies, you could say that the academically defined rate of inflation is zero, in the sense, it doesn't mean prices aren't going to change over the next year or 10 years, but it means a person now who gets on the phone and wants to buy gold for delivery today, delivery next year, delivery 5 years from now, gets it at the same price. He doesn't have to pay more because he doesn't want to get it for 5 years because the interest rate's zero. Okay, now if interest rates were 10% like they were in the 70s, and you wanted to buy it for a year from now, 2 years from now, the price you'd be facing, the term structure of prices would be continuously increasing at that 10% rate. And it might cost you, instead of if it was £1,000 for spot, it would be $1,100 if you wanted to not take delivery and pay for it for a year. Over 5 years, it would probably double, with compound interest. So it would be £2,000. And that would be the prices in the futures markets too, for gold, for silver, for all these non-perishables that with very low storage charges. The term structure of prices reflects the interest rate. The interest rate is the rate of inflation as academically defined as the term structure of prices faced by people today looking to make decisions to buy and sell in the forward markets. And so that doesn't mean the price is going to go up because the term structure of prices are up. Where the futures are doesn't tell you where they're going to be. That's a whole different thing. But right now, if you want to buy it, that doesn't matter. That's what you have to pay. Or if you were a gold miner and you want to sell, those are the prices you're going to get. So in a zero rate environment, the gold miner is going to get the same price for, he wants to sell next year's delivery now and get paid for it then, he's going to get the same price. He's not going to get a higher price. If interest rates are 10%, he's going to get a price 10% higher. So my point was that not the CPI, but the academic definition of inflation is a direct function of the policy rate of interest. The rate the Fed is setting, the rate the BOE is setting is determining this term structure of prices for the entire economy, non-perishables, and then relative value, bringing in the rest and different kinds of expectations. But it's all in the context of this non-perishables appreciating at nominally at the rate of interest, right?
Let's just go back to Darren's point, and I think you are agreeing with Darren's point, which is that in the interview that you did with Steve, and you've said it in other places, that you were basically saying the overnight rate is the inflation rate as inflation's academically defined. It doesn't mean that when you get to that point in a year's time or 10 years' time, it will turn out to be true, in CPI terms, but in terms of the academically defined inflation, that is the case, yes?
Right. Those are the prices faced today by people alive today who want to buy or sell for future deliveries. So if you're a jeweler and you want to buy gold for today, it might be £1,000. If the term structure of rates is 0 out to 10 years, you say, look, I want to buy it, and you deliver it to me 10 years from now, and I'll pay you then. It's still going to be £1,000, plus storage or insurance or whatever. But if the rate's compounding at 10% a year, if the 10-year rate is at 10%, then if you're a jeweler and you want to buy gold for 10 years from now, it would be at, what would it be? Probably £3,000, right? Because it's 10% compounded for 10 years. So, it'd be £1,000 to buy it for spot, £1,100 if you buy it for delivery 1 year forward, 10% higher than that for 2 years forward, which would be 1110 or something like that. 1,210 or whatever it is, and it'll compound on out. Okay, so the term structure of prices faced by a jeweler, faced by a gold miner who wants to sell gold, if the policy rate is at 10%, he wants to sell his gold for next year, the year after, he's going to successfully get 10% higher when he sells it today for delivery 2, 3, 4, 5 years from now. So that's the rate of inflation academically defined. It's the prices, the term structure of prices faced by today's agents. And that price is continuously increasing at a direct function of the policy rate of interest, the term policy rate of interest. And so the risk-free rate, the term structure of risk-free rates set by the central bank. And so when they raise their rates from 0 to 1%, they've increased the term structure of prices from 0, no inflation over the next 10 years, to a 1% rate of inflation being faced by today's merchants and people involved in buying and selling for delivery next year, the year after, and the year after. So they are setting that term structure of prices that we all have to deal with as part of the economy. And it directly affects the non-perishables and indirectly the perishables through relative value. And whether the price changes tomorrow or the next day or 5 years from now is not what this is about. It's what you have to pay right now if you want to buy those things, or the price you'll get right now if you want to sell those things. So that's what's meant by that. And the interesting thing is, this rate is a direct function of the policy rate, right? And the central banks have never even considered it. With all their research, they've never looked into it. They've looked into what change is going to happen in this basket called the consumer price index they carved out to try and replicate some kind of standard of living, how it changed last year, how it might change the next year. But the actual academic definition of inflation, to actually look at how that affects things, they haven't done it. And so maybe if they looked at it, they'd say, you know what, it's irrelevant. We shouldn't bother to do this. It doesn't affect anything. Or maybe they look at it and they say, this has a major effect. They've got the billions of dollars they're spending on econometrics and research and everything else. They haven't put a penny into this. And to me, because it is the thing they're affecting directly, and because it's intuitively going the other way that they're thinking, higher rates are the higher inflation rate, that they should at least look into what they're doing.
Just for clarity, is another way of saying this that the central bank sets the interest rate with an expectation of what will happen to inflation in the future. But by doing that, they are actually affecting the inflation rate itself without knowing so.
They're changing today's inflation rate faced by all of us. So by raising today's inflation rate faced by all of us, they think they're causing the CPI to not increase so fast in the future. And it doesn't happen. Okay? And so
sorry,
they've gotten
it wrong. Just jump in. You said when they raise today's inflation rate, Did you mean
the interest
rate? Yeah, got it.
Well, it's the same thing, right?
Yeah, well, yeah, that is the point. Yeah, got it.
If they raise the inflation rate we're facing today, buying and selling for forward delivery, they think that will cause prices in the future to go down or to not go up so fast, right? To slow down the rate of CPI change, consumer price index change. So when they raise rates to 10%, now all of a sudden the house, if you want to build a house, and it's going to be ready a year from now, it's going to be 10% more because of all the inventory and all the finance involved in holding that house for a year. And you don't have to pay for it for a year, so you get to earn 10% on your money, so the demand is there. So they've just raised that price. If it's going to take 3 years to complete, they've raised it by probably 40%, right? And somehow raising rates like that and causing us now to face a higher rate of inflation in our decisions we're making today to buy and sell is supposed to bring down the rate of inflation as they measure it, which is the CPI, and it hasn't worked. Mm-hmm. Maybe this has some insight into one of the reasons it doesn't work, among others. My other reason is the interest income channels. To me, it won't work because of those channels also. So you got forward pricing channels and interest, income channels, both telling me that this interest rate tool, they got it backwards. And I've been saying this since, I don't know, I remember being in a central Bank of England meeting in maybe 1996 or 7 or 8 or something, with guys from the Bank of England, guys from the Bank of Japan saying the same thing. So it's not like a new idea I've had. I did that paper, zero is the
natural rate of interest is zero.
Natural rate of interest in 1997 or something?
Yeah.
It's not like some new idea here.
Darren Quinn had a second question. This one is one that actually interests me, and it's a very simple question. How is a swap line priced?
First of all, what is a swap line?
Yeah. Let's begin with that.
Okay, behind all the rhetoric, it's an unsecured loan from the Fed generally. It's an unsecured dollar loan to the European Central Bank, to the Bank of Mexico, to another central bank. And the reason they do it is to keep interest rates from going above their desired levels. So if the Fed sees dollar rates in Europe trading at 3% and they want them at 1%, they'll go to the European Central Bank, or at least this is what they did in 08, 09 when they first did it, and say, look, we don't like rates up at 3 or 4 for US dollars. We have a lot of corporations borrowing at LIBOR. We got US homeowners borrowing at LIBOR. We're trying to get the rate at 1. That's our policy rate. They're paying 3 or 4 because that's where LIBOR is being set, because that's the rate paid by weaker European banks to borrow money, to borrow dollars. We want that rate down. So what we're going to do is we'll lend you dollars at 1%, and you can pass that rate along to all these banks. And now that becomes their cost of funds. That becomes their LIBOR setting. And then our clients, our domestics or whatever, the people we're concerned about, will be paying lower rates. And that's how we're trying to help the economy. So we're trying to transmit this monetary policy, which is the lower interest rates, and it's being blocked because LIBOR is not going down because they're putting a premium on risk or whatever. And so what we're going to do is lend the money to all these banks through the central bank so that the interest rate will come down. So it sounds pretty stupid.
So this is in the interest, this is in the interest of the US Central Bank.
Yeah.
Can we just say what LIBOR is just for a second?
Yes, the London Interbank offered rate is set by the British Bankers Association, which is an independent group in the UK. So for the US, it's a foreign entity that polls their banks that they've put in the index and asks them what levels of you're seeing to be able to borrow money for 30 days, 60 days, 90 days, a year, whatever. They they throw out the high and the low and take the average of those, and they publish that as LIBOR. And what you have are U.S. banks and businesses that are indexed to that rate. They've contracted in LIBOR as their index rate. So, and the BBA is supposed to not include banks that are troubled or paying premiums, but they do, because they're not going to throw out Bank of Tokyo or Mitsubishi Bank. They're massive clients just because, in 2008, they got hit with higher rates or whatever. And so they didn't want to dishonor people. So they started including these banks that should have been tossed out of the basket because the rates were way over the Fed's policy rate, so they obviously must be risk. But they can't throw out all the big banks either. They were all considered to be at risk. So the Fed had a problem with, rates for homeowners contracting to LIBOR are 4%, not 1%. And they're paying LIBOR plus 2, they're paying 6 instead of 3. And so they said, okay, well, we'll lower rates. We'll lend you money unsecured. If you go broke, you don't have to pay it, so that you'll be able to show lower rates to these guys in England, so that our homeowners will be able to pay lower rates. Talk about a convoluted, insane policy. Okay, so now that Fed went to Congress and told them that this lending was fully secured. I told you it was unsecured, right? Mm-hmm. They said it was fully secured. Why? Because the European Central Bank would put up euros as collateral. The Bank of Mexico put up pesos as collateral. Okay, so they're lending money to the European Central Bank. They put up euros as collateral. What does that mean? It means they have an account at the central bank that they credit euros to. They just change the number up and label it as collateral for the Fed, that you have this number of euros to do what you want if we don't pay you your dollars. All right, they control that account. If they decide not to pay the Fed, and the Fed says, all right, I want you to sell my euros for dollars, they could have done that without the Fed with their own euros, right? They've already decided not to do that. They're not even going to answer the phone, right? Okay, so this is like lending money to somebody against their watch, but they get to wear it, and they live in a foreign country where you have no jurisdiction. This is exactly what I said to Jim Klaus at the Fed, who was senior guy in monetary affairs. And, he said, he was talking about the swap lines, and I said, well, and being a little bit defensive about how it helped. And I said, well, look, I don't have any problem with that, except that it's unsecured. He goes, no, it's fully secured. We have, deposits, euro deposits at the ECB. And I don't say anything for about 5 seconds, and all of a sudden his face drops, and he goes, not a word was said. He goes, oh yeah, point taken. I mean, it didn't take him long to figure that. I said, if I ever did that with my bank, there's no regulator that would call that a secured loan. He goes, yeah, I know. So he said, but technically, that's how we sold it to Congress, as a secured loan. And so that's what the swap lines are. It's making these unsecured loans for the further purpose of bringing. So I said, if you want to bring down LIBOR, because these guys aren't setting it properly, just send the Fifth Fleet up the Thames and tell them what you want them to do. But you really shouldn't have foreign agents. And my proposal, even before that, was to not allow banks to contract in LIBOR, because it's being set by what I called at the time these, octogenarians sipping sherry at 10 o'clock in the morning, on the Thames, wearing bow ties, figuring out telling us what our interest rates are. Like, what are you doing? Why would you allow a U.S. member bank to use that? Well, everybody's using it, and it's internationally. So what? If they're all jumping over a cliff, you're going to tell our banks to jump over a cliff? So this year, just not long ago, the Fed has finally come up with something saying they're not going to permit U.S. banks to contract in LIBOR. I think it takes effect next year. It took them 12 years. 12 years.
12-year lag on anything you say.
So now with that context, what's the question about swap lines?
I think that was the interesting point about swap lines. The question was, how is it priced?
Oh, the Fed sets the rate.
Oh, okay.
Because it's based on where they want rates to be. That's the whole point.
Here's another quick fire one from Ganesh. If a central bank targets an interest rate at, say, 1%, does the Treasury then issue any new debt at that interest rate of 1%? And if not, why? Okay, so for all practical purposes, yes. And that would be if the Fed's target for short-term rates is 1%. And in fact, usually the Treasuries are a little less than that. So the Treasury bill, the 3-month bill, would be probably 0.9 or something like that. Now, the 10-year rate might be higher because that would reflect the anticipation of what the Fed's going to do at the next meeting, and the next meeting, and the next meeting. So the forwards are anticipations of what the Fed's going to do, plus or minus technicals. You might have somebody ordered to buy or sell or something like that. So it's expectations plus just technicals in the marketplace. If they wanted to communicate that interest rate, and in a world without bonds, They could just pay interest on reserves, right?
Yeah. And they could say it's permanently at zero for the next 10 years. They're not going to change it or whatever. And then the 10-year term rates would be 0%.
Great. And really that's what you're advocating, or that's your base case for analysis, right?
Yes.
And when we say that, but in practical terms, it's just easier legislatively in the US to just go to nothing longer than a 3-month T-bill, is it called?
Yeah, that's right. 3-month Treasury bill, yeah.
Okay, right. This is from Sam Hollenbeck. It's about job guarantee. I've been hearing differences between academics and experts on how our economic baseline should be shaped for our people in terms of a job guarantee and basic income. Some people, so this will be about how you personally feel about it, Warren. Some people feel we should have only one or the other. Some people believe in a hybrid system of, basic income and job guarantee. Some people believe in a hybrid that has a basic income for people who truly can't work and nothing for anyone who doesn't want to work for whatever reason. Others feel that there's a multi-tiered system would be more appropriate, that would offer a socially inclusive income for people who can't work and a reduced amount for people who don't want to work. But Warren, if you had the magic wand and you were able to establish the economic baseline in your own vision, how would you shape it, and what would be your reasoning behind your decisions?
Well, I'd start with the job guarantee because, we have this, it serves public purpose to transition as many people back into the private sector as we can, because that increases output and, employment and real output, and makes us all wealthier and raises our standard of living. Increases domestic output. So number one, regardless, you want to get as many people working as possible. And the unemployed have been taken out of the private sector by taxation. They're stigmatized. We need to get them back in the private sector. Now, if we need more people in the public sector, fine, just go hire them. That's not what the job guarantee is for. The job guarantee is not to put people in public sector employment. We can do that anyway. Okay, so assuming we've already done that, we've already staffed the National Health Service to desired levels, and they're still unemployed, we want them back in the private sector, right? So do the job guarantee first, sort that out, and don't change anything. You don't change unemployment compensation. You don't change anything. So all the social safety net is all still there, but all you do is add this voluntary job guarantee at whatever wage they decide on. I say non-disruptive to start, but whatever they decide on. And then just leave it there, and then take another look at universal basic income and all the others, and then modify it from there. And if you think, okay, it's good, we've got this job guarantee, we've got people transitioning to the private sector, it's they're getting paid, they're still collecting unemployment if they don't want to do this for 6 weeks or 10 weeks or whatever it is. Are there people falling between the cracks that we think should have UBI? And if the answer is yes, then you can go ahead and look at that. Again, you got to be careful not to make it a living wage, or else you can, but you're playing with fire. You can undermine the whole system. But, short of that, it can be done. So I'm not categorically against it. It's just you got to be careful. That's all. But I'd say we know the job guarantee serves public purpose regardless of what else you do. UBI is not going to get a job for anybody. You're still unemployed. You're still stigmatized by not having worked. You're going to have income, you're going to have a life, but you're not going to get a job. If it's important to have people working, producing output, you need the job guarantee to transition people into that who are not in private sector employment right now.
Just to make it a bit more real for people, let's say in the States, because the States, when you say a non-disruptive wage, what are you talking about? Obviously, we're not going to hold you to it when you become president.
Well, in theory, you could start with $100 an hour. And then the whole system would adjust to that. Yeah. Well, and then everything would adjust. The whole price level would move up. And you can do that, but what's the point? As John Cleese would say, what is the point? So so you don't want to do that. And you don't want to be at $6 an hour where nobody shows up except people who can live on 800 calories a day. So, the answer is somewhere in between. 12, 15, something like that. It used to be 8 when I first started talking about this. That was a long time ago. So now maybe it's 15 or something like that. Last year, 2 years ago, it may be 12, and now it may be 15. So let's say it's 15. You don't want to be at a level where suddenly you're getting 20 million people, you're emptying out all the fast food chains and everything else. And suddenly the government's overwhelmed by people who are already working that shifted to this because it paid more. All right. You just don't want to do that on the first day. Now, other people say, yes, we do. That's the whole point of the system. It's like, okay, so it's a little bit of a political decision. For me, I don't want to empty out all the private sector employers the first day. So if they're paying $12 or $14 an hour at Walmart, McDonald's, I'd start at 12 or something like that. I wouldn't go to 15 and try and get people to leave all the department stores right now. I just don't see that as good policy.
Do they empty out on day one, or do Walmart go, well, we can't run this business on no employees, we're going to have to pay 16?
Exactly. So I don't want to find out the first day, and I don't want to risk the whole thing on that, because it can always go up. I was at a Fed meeting once with their international economist, and they were talking about a policy, and she goes, well, it's kind of like when you put a frog in the water. If you put him in boiling water, he just jumps out. But if you put him in, warm water, he'll stay there. And then as you get it hotter and hotter, he'll eventually jump out, right? So she says, not that we do that here at the Fed. I don't want you to think we're boiling frogs in water. She was very good. She was one of their better economists. But anyway, so it's the same thing. So if you start at 10 and then you go to 11 or 12 or 13, over time, you'll find a level where people start leaving a little bit instead of just causing massive disruption on day one. If you go to 10 and nobody shows up, it's not the end of the world. Nothing bad has happened. You're no worse off. You go to 11 or 12, you start getting some people. Okay, then you can start formulating your policy. So being disruptive, I don't think serves public purpose. I think it serves a lot more public purpose to start at lower temperature and then work your way up. But, I'll probably get overruled on that. But that's just me.
Okay. No, I think there's a lot of people who kind of, follow MMT, and there's loads of people with that are, would like their material conditions to change as fast as possible. So they're probably on the, they're probably on the, let's bring that baseline up as fast as possible, please. So.
Yeah, and they're voters, and I respect that. I'm not against it. It's just it'd be disruptive. That's all.
I think Andrew Lloyd's comment, it's more of a comment than a question, but it might lead to a nice question. So Andrew Lloyd said, and I'm assuming he's referring to the wage level of the job guarantee.
This is about how can the job guarantee be a socially inclusive wage where there's lots of disparity between regions in the cost of living?
So he says that we should set it at the rate needed in urban areas, and then obviously the rate needed in non-urban areas in rural areas will be likely to be lower. Is your view that it should be the same for the whole nation, or that they should be different depending on the area?
Well, it depends. If you're trying to bring up the rural areas, or you want this difference to persist, you think it's okay? Is it? Do you want people to migrate from rural to urban? Do you want them to stay where they are? Do you want them to migrate from urban to rural because lower cost of living and a higher wage? So you got to look at all these aspects of public policy, and I'm good with either one. I would start off with, I think we're starting off low enough now where fairly soon at, say, $12 an hour, you might get a lot of people in the regions. In the urban areas, you don't get very many, but you don't get a high unemployment usually in the urban areas. I mean, I know you do, but when there's disruptions, but that they're getting unemployment compensation and everything else that's higher also. And so personally, I don't have any problem with a split or with some kind of a differentiation. I don't have any problem with using one to start and then seeing what happens. And if you're bringing it up, the minimum wage law is national. And so I think the idea is you want to bring up the regions to the urban levels. But if you don't want to do that, then you have to have a discount at the regions. So usually the urban areas are higher because they're getting paid more, right? Because there are more jobs and there are more openings, and everybody's getting more money already. So they're already getting $20 an hour working in a restaurant and not 12. If they're only getting 10 or 12, then you can keep it the same as in the urban area. If they're getting 20 because they're in demand and they're trying to get people to move from the regions to the urban areas, then you don't need to do it. You don't need to have the high wage there. You've already got the employers trying to get people that can't get them. So look at the unemployment rates, look at the differences. There are times when the unemployment's regional. There are times when, like in Detroit or something, it's urban. Those decisions, I think, are less important than the idea to just start with something non-disruptive and then bring those factors in, make your modifications. But at least start with something and get going here. And the thing I think everybody can agree on is starting with a non-disruptive wage is not a bad thing. And then you can argue, the different factions can argue about how high it ought to be and whether it should be higher in certain urban areas around. You can have states supplement it. New York could supplement the wage in New York City if it wanted to do it. It wouldn't cost them a whole lot, and it might fit their public purpose as a state.
Great stuff. This is another one from Darren Quinn. Scott Fulweiler says that you joke that the monetarists are right and that they measure the wrong thing and should measure net financial assets. How accurate is that?
Oh, I think that for a given level of savings desires, which changes, which would include the foreign sector as part of your savings desires, that things correlate fairly well to net financial assets, which is a public debt. So you can see how it goes up and down cyclically and has some kind of a causal effect. When it goes higher, the economy gets better. The automatic stabilizers, right? And so I think that's the correlation they've been looking for with their monetary aggregates like M1, M2, and M3. And I think that you do get that kind of a correlation, at least broadly over time, with net financial assets. And there's even a causal part of it because, we just proactively had a $2 trillion fiscal adjustment. It added $2 trillion of net financial assets and it supported the economy. And so I would say we increased the money supply as measured by net financial assets when we increased deficit spending, right? And it worked. So that's why, in that sense, I think it replaces what they thought they were doing with the money supply. They would have the Fed increase the money supply and watch for the economy to change, and it didn't do it, right? We had all this QE. There was no response to the economy when M1 or M2 or something went up. But when we did the CARES package and net financial assets went up 2.2 trillion, incomes, consumption, everything, all these other things measurably went up by, a lot, with some kind of a multiplier. So, that's why I think that's the measure of money supply that the monetarists have been looking at. And if you look at it in terms of gold, for example, fixed exchange rate policy, it's the same thing. When we used to buy a lot of gold, that would increase the money supply. We'd pay for it with new gold certificates, which is functionally deficit spending, right? You're buying gold and printing gold certificates to pay for it, or crediting accounts, reserve accounts, which were convertible to pay for it. Then you got inflation. You got, in the economy, you had an expansion, you got prices coming up. And that would happen when there was a gold discovery. So they had the right measure of money supply, which was base money, when they were on the fixed exchange rate. Okay. And it's the same thing when you have a peg currency. So I think it is the M that the monetarists have been looking for. It's the net financial assets.
Great. This from Owen Edwards. I've jumped to this one because I see this a lot now. This whole thing about it's okay to increase the deficit. It's okay to do more borrowing, quote unquote borrowing, because interest rates are so low. And I don't think that's a kind of MMT take, but it's getting conflated with MMT. So the way Owen Edwards asks the question, he says, MMT seems to be getting some mainstream traction, but with the caveat that rates are so low, so debt interest is low. So can Warren counter this? Does long-term debt interest depend on the market? I know that short-term interest rates are set by the BOE and that they don't have to issue bonds, but how do we counter this with the current system?
I think Stephanie pointed out, that, under Reagan, we had high rates and the deficit spending was, very high and relatively high. It doesn't matter. The government can conduct, deficit spending regardless of the rates. That's not a factor. So rates are not a factor in your ability to conduct deficit spending. You can do it anytime you want. Rates can be 30% like in Turkey or something, or they're 15 now and they're doing deficit spending. So pretty much all countries conduct deficit spending regardless of where the rates are. And there's nothing operationally stopping you from it. Now, the high rates, themselves in my book are inflationary. And so deficit spending when rates are high tends to support or prolong inflation, you might say. So I'd say, the Reagan era had prolonged inflation. It stayed 12, 10%, 9%. It took like 10 years to get down to 3%, even though we had oil prices coming down from 40 to 10, which would normally, say today, be a highly deflationary event. But in the context of their high interest rates, these types of things kept the inflation higher than I think it would have. The high rates kept it higher than otherwise. The other thing is, which I do and the other proponents don't do, is I immediately point out, look, raising rates causes inflation to go up. You lower rates, cause it to go down. And 0 is a rate that promotes no inflation. It's not a rate that promotes high inflation. Look at Japan, look at Europe, look at the US. Okay, and look at the theory, and look at forward pricing, and look at everything else. Fed's had it backwards. If you understand that, and you engaging in deficit spending, and they say, well, if rates go up, it's like, well, why would they raise rates? You say, to fight inflation. Well, we just established that backwards. Sure, if they raise rates to fight inflation, they're going to cause more inflation. We all already agree with that. Then it becomes like, an inapplicable argument. Then the argument is, okay, rates are going to be 0. We're going to conduct the deficit spending we want. The only reason we'd raise rates is if we want to add more inflation for whatever reason. And raising rates, of course, the channel is you're paying, interest, you're paying, to people who already have money. So it's what I call basic income for people who already have money. So even the people who you're talking about basic income, I don't think any of them favor basic income, but just for people who already have money. There's no constituency to do that. Yet that's what you're doing when you're raising rates. And, so if it just becomes a stupid policy that you don't say, I'm not going to deficit spend because if rates go up to fight inflation, then we're going to get inflation. It just becomes a nonsensical argument. So for an MMT proponent to use it violates what's called Lerner's law. Don't concede the principle. Because if you start doing that, you're going to get caught out on all kinds of things, contradictions you open yourself up to all kinds of contradictions with that kind of an argument.
Is it also fair to just say, look, whatever the rates are in future, whatever the future generation decides to do, the government is always going to be able to pay debts on time in full, denominated in their own currency because they issue the currency. So it's not, this people go, it's the interest that's killing us. And it's like, it's not killing us, right?
But the new Keynesian argument is that if the deficit gets too high, and this was Paul Krugman, he said, look, if the reason you can't do it, I'm saying, which is to have a job guarantee and sustain full employment, is if the public debt gets too high, then if the Fed has to raise rates to fight inflation, the interest itself payments will cause more inflation. And then you have runaway inflation. And my answer is I said, yes, absolutely. Raising rates causes more inflation. And then you don't have to wait for the debt to get too high. It's already there. So it's already plenty high for that.
They're concerned that monetary policy isn't going to work as a means to control inflation when it already doesn't work.
When it already doesn't work, right. That's the thing. And they'll say that it already does work, but they don't have a single study to show that it works. The best they can do is find something that says, a 1% increase in rates will lower inflation by 0.25% over with a 2-year lag or something, which always crosses a fiscal cycle and they can never test for it. They don't have anything.
We've kind of danced around this. This is a sort of follow-up from Tal Ariel, who just sort of said, related to Owen Edwards' question above, I'd like to better understand the relationship of interest rates to inflation, which we've already talked about. And then he says, MMT works where the interest rate is low is a common roadblock in discussing MMT. Okay, all right, we could do MMT, but only when interest rates are low.
MMT isn't what you do. What you do is deficit spending.
Yeah. And then he sort of he's saying as a layman, I don't quite understand this equation. So hoping to get a layman's explanation, but maybe we've already said enough on that. I don't know. What do you think, Warren?
Yeah, the interest rate is not an obstacle to deficit spending. Yes, high rates will cause inflation. That's one of my basic tenets. But look, the other MMT proponents don't lead with that the way I do. And I think it weakens their arguments. It makes it more difficult. They'd say, look, if you raise rates, it's going to cause inflation regardless. Public debt's already high enough for that. So why would you do it?
If I read you right, your sort of advice to MMTers who've been at it a while now really need to get au fait with what we just talked about, the forward pricing channel, the way that affects inflation, and obviously the interest income channel.
Well, I don't know how forward pricing affects inflation. The CPI.
The academic definition.
I know what it does to the academic definition, but I don't know what it does to the working definitions of inflation. I don't know what it does to CPI. I just don't know. But I do know the interest income channel is there, and it's right in the new Keynesian economics. So just use it. Hit them on the head with their own theory. They've got their own contradiction right there. Just lead with it right between the eyes, right up front. And also sequence. Start with sequence, and then, we agree with the new Keynesians. If you raise rates, you're going to get higher inflation. They've already said that. So what scenario would you see rates going up if that's going to cause it? Why would the Fed do it if they're fighting inflation? Why would they throw gasoline on a fire if they know it's gasoline? They think it's water. But once they know it's gasoline, why would they do it?
That's a great way to put it. I have other questions, but we should just wrap up because we've had you on the phone for far too long. So thank you so much, Warren. You're so generous with your time on these things. I was just going to wrap up by asking you if you had any thoughts about the Biden-Harris administration, what to look out for, what you think they're going to do.
So the important, the decision was not to elect Biden, but to remove Trump. It's like 58% of Biden voters said they were voting against Trump. He never had a lot of support in the primaries or anything else. But so Trump lost this, as an big anti-Trump vote. And to me, the biggest problem with Trump was that he had hyper-politicized the justice system, where he was just using it for personal gain. And, law was just one more politically correct thing that you don't let get in your way of what you want to get done. And so, not that the other presidents haven't done it, but never to this degree, never blatantly, never publicly, never, shamelessly like this. They all at least have some reservations about breaking the laws. And he just doesn't. That's just, how you do it. And so that to me, that is what turns you into Venezuela or Somalia and not socialism. All these, it's I think the political debate has gotten the wrong causes behind what causes Zimbabwe or any of these other things. And it's been, hyper-politicization of the legal systems, where, the legal system becomes the guys in the street with the Humvees and the machine guns deciding who gets arrested and who doesn't, right? And so, and the same thing in all the dictatorships. That's the biggest problem is, the Putin controls the legal system, and same thing in China. The Communist Party controls the legal system. And that's what he was shamelessly pursuing, and every day and continuously pursuing whatever without concern. So that had to go. So we got rid of that. It's not like we got somebody in there with policies that we like or anything else. It just, this other thing had to go. It was not, and so now what do we have? We have not much. We're back to the old political appearances. Your cabinet looks like this and all this politically correct stuff that people were against, and that gave Trump whatever initial popularity he had. However, when he pushed it to these extremes of politicizing justice, he lost enough people around the edges, to lose. But now we're back to what the whole anti-Trump thing. And so I don't know what we're back to now. We're certainly not back to any kind of a progressive agenda. And they've made a point to say that. So whether things will happen or not, I don't know. Whether we're back in some kind of quasi-neoliberal, slow motion, politically correct government, probably. But, we'll give him the benefit of the doubt, reserve judgment to see what happens. He hasn't even taken office yet. But I don't have any high hopes for him. I don't even think he wanted to be president. I just think he saw that he was the only one that could take out Trump, which he was. None of the others would have done it. They all would have lost. He had to be able to get enough former Trump voters to come across, and he was enough of, plain vanilla for that to happen.
You think Bernie would have lost that one?
Yeah, by a lot.
Controversial.
Yeah, he got labeled as socialist, and he would have communist and everything else, and he would have lost all these Republican moderates that voted for Biden or stayed home. I mean, I would have preferred him getting in, but I don't think he would have won. You can't look at the percentage Trump did get. You could say, Biden was closest to those. Sanders wasn't going to take any of those.
Well, it's an open question, I guess.
Yeah, I could be wrong, but certainly there was a big turnout on the Democratic side just to get rid of Trump. So it wasn't. You didn't have the Clinton problem. Yeah, where there was no turnout, because I think Sanders could have beat Trump the first time. I think Clinton was Trump was the price people paid to block the Clintons. And now this time, Biden is the price they paid to get rid of Trump.
Yeah, that's about right.
And do you think AOC has a good chance for the next session?
No. I mean, I certainly have more respect for her than any of the others, but in Congress, but I don't know that her ability to convert it into any kind of a majority, any kind of a majority that gets policy done. I hope so. But it's the mood of the United States just doesn't seem to be that way right now. But maybe it will be in 3 months or 6 months. I don't know. And she's lost a lot of opportunities. Back when Amazon was looking to locate in her district, they were demonizing these companies for what they do, and they didn't want them in their district. And you could say that's not what really happened, but that was certainly the impression out there, and Amazon decided to go somewhere else. And as a congressperson, congressional representative, it was her opportunity to recognize that, fallacies of composition, what was going on and what was causing this. And what happens is there are no federal standards for these companies. Like in Europe, there's no unified corporate tax. So companies compete with each other with the lowest tax codes to like Ireland. You can't have that. You have to have a unified tax system. Otherwise, it's just a big race to the bottom to starve, public funds, right? So at the state and local level. So corporations shop the states and shop the localities to get the most benefits, and then go to the one that gives them the most benefits. And so the one that gives them the most benefits is the one willing to have the lowest levels of education and the least public services for everybody else to be able to get those jobs in. And the ones that aren't willing to do that don't get them, and they're even worse off. And so there's this huge race to the bottom going, and it's the job of the federal government to stop these races to the bottom and have some kind of, unified standards for how these corporations will be taxed in any jurisdiction. So they can't they can't play off these regions against each other. Well, she's a member of Congress and didn't point that out. That was a golden opportunity. She had the public's ear to point out a legitimate function of Congress is to do that. So it's like the classic example is if you go to a football game and you stand up, you can see better. But then the people around you can't see better, so they all stand up too. Well, now nobody can see better and nobody can sit down. So you have to have collective action. You have rules that say you can only stand up for 15 seconds or something like that. And nobody calls that socialism or communism. It's just common sense rules to prevent this fallacy of composition so everybody can watch the game. And it's a role of government. And same thing with the environmental regulations. We left all the states to do that. And so the states that allowed the most environmental degradation got the most businesses. Then the rivers in Ohio start catching fire, and they realize you have to have federal standards to stop these companies from playing these regions off against each other. Well, AOC had the perfect opportunity to step up, be macro, be presidential, show national leadership, and show the role of Congress, and what the role of Congress is in these incidences where Amazon is playing everybody off against each other. It's not their fault. It's the federal government's fault. It's Congress's fault for not stepping up to their role as preventing these fallacies of composition, these races to the bottom. And she didn't do it. And I talked to a couple of people in Newark and pointed it out, and they didn't want to go there. And so that was a massive, massive disappointment. So it's not like a criticism that she did anything wrong, did anything everybody else doesn't do, but it's just an enormous teaching moment type of thing that was lost to to move the country in the world really in a much better direction that serves public purpose. But maybe more of those will come up, and maybe next time, we'll get it done. So that's where I stand on those types of issues.
I don't know much about Biden's picks for Treasury or Fed chair.
Janet Yellen. I met with her a couple of times. The last time I gave her my book, but I don't think she ever read it. And she's a very nice person, and no conspiracy theory. She believed in low interest rates, but Trump replaced her because she wasn't tall enough. She was only 5 feet tall. He thought the Fed chairman should have more stature, so he brought Powell in. He said he hired people based on central he called them right out of central casting. I want generals who look like generals, and Fed chairman who look like Fed chairman. So anyway, he went out and raised rates. So he shot himself in the foot with that one. But that actually helped him, but he didn't know it, of course. So anyway, she's not going to. The Treasury Secretary signs his money and runs the Secret Service and is an advisor and goes to meetings and reports back. But there's no real authority, but it tells you who he's going to have for his advisors. And he's not going to be getting any, advice that's going to be moving, a progressive change from Jenny. Maybe it will. Maybe she'll read my book.
I think maybe the picks themselves are the
window dressing.
Yeah, well, they're also communicating to those who need to know this is the direction we're intending to go in. Right. But, like when Obama did what he did, when he came in with a massive mandate to make quite radical change, but he just got the same people who caused the crisis to come back in and, pretty much sort of said to the establishment, don't worry.
Yeah, that's right. Same kind of thing seems to be happening to a lesser extent, but same type of thing.
But also, I think, the impact that you've had via Stephanie and Stephanie's book, I think, I don't know, it seems from this vantage point, it's been a different conversation about paying for coronavirus this time than it has been.
Oh, no, yeah. And you got to give Stephanie all the credit. Yeah. I think she is clearly the most influential economist in the world right now in terms of influence. None of the others have had the kind of influence she's had and will have for the next year. So we'll see how the rankings come out, but I wouldn't be surprised to see her right up there as number one most influential economist. And rightly so, and all in a positive, constructive direction. So it's good to see that.
Yeah, for once in a positive direction.
Yeah.
We've got a lot of reasons to be positive, and they all come back to MMT.
Look, quietly without the headlines, Bill Mitchell's been right there also, right? But he doesn't have the splash from the book.
On the grassroots level, Bill Mitchell has been. Yeah,
or the visibility. But boy, he's there everywhere, tirelessly around the world.
Yeah.
And even this textbook that he and Randy did is, through the back door has enormous influence.
Yeah, no, that was remiss of me not to.
It won't be recognized the way Stephanie's will be recognized. She has the headline influence.
Celebrity's a weird thing, isn't it? You can't, it's very hard to control.
Yeah.
I think that's a great place to leave it, Warren. Thanks for all your time, and I know the listeners appreciate it.
Oh, well, you're the best, so just let me know what I can do to help.
Oh.
Thanks so much.
Take care. Bye-bye.
That was the MMT podcast with Patricia Pino and Christian Riley. Don't forget, you can support the show through Patreon, starting at $1 a month and get access to patron-only episodes. You can do that by going to patreon.com/MMT podcast. You can also find me on Twitter at MMT podcast, and you can find Patricia on Twitter at Patricia N. Pino, and you can email us at mmtpodcast@outlook.com. Thanks for listening, and we hope to hear from you.